Okay, everybody, here we go. We're going to talk about Chapter 31, and we begin with the functions of money. So remember that, first and foremost, money is a medium of exchange. Okay, so this is basically what the functions of money are. We use it to buy and sell goods. That's what medium of exchange means. But we also use it as a unit of account, meaning we know what something is worth by how many dollars it is, right? So something being worth 10 is helpful because we know that it's worth less than something that is worth 20. Okay, and that's important. We know what something is worth in a meaningful way. Okay, finally, or not finally, but additionally, money is a store of value. So imagine you are a farmer and you have a really good crop and you sell all your stuff. Well, what are you going to get for it? You have to get something that you can store because you had a really good crop, so it's something that's going to last, right? So money becomes something that you can store, okay? And then finally, money is liquid, meaning you can exchange it quickly from one form to another form. Those are all important things that money must be. So when we talk about money, we have this idea of M1, M2, and M3. M1 is currency and then your checking account. So this is primarily what you guys think of when you think of money, right? So currency, that's the stuff in your pocket, and then your debit card, your checking account. These are primarily offered at commercial banks, S&Ls. These are just a lot less common than they used to be. Some of you guys might go to credit unions, but for the most part, commercial banks is really where M1 lives. That and out in the world, right, in cash registers and wallets. Okay, but money is more than that. As I've mentioned in class a lot of times, money is bigger than just what we conceive of as currency. So there's also what we call M2. Now you can think of these as those Russian nesting dolls, where M2 includes all of M1, and then other things that we call sometimes the near monies. These are things that are similar to what we would traditionally call money, but not the same thing. So this includes savings deposits. So your checking account is part of M1, that's money. But savings accounts actually are considered M2. It's a different kind of money. This probably never means anything to you, but technically speaking, if you read the really fine print in your savings account, you might have to give them notice before you can take all your money out. They might require 24-hour notice or 72 hours notice or something if you withdraw more than a certain amount of money. For most of us, we don't keep that much money in our savings account, so we wouldn't hit that threshold. But in theory, it could matter. Okay. So in addition, we have the small denominated time deposits. So these are CDs, or certificates of deposit. Those are interesting because they pay you a higher rate of interest. But once you purchase them, basically, your money is locked in the CD for the length of term that you bought the CD for. So maybe 3 months or 6 months or 9 months or a year or 18 months or whatever. You can buy all different versions. The longer the money is locked away, meaning the less liquid it is, the higher interest rate you get. And that makes sense because the banks know that they can use that money and they're not going to have to produce it to you, because if you try and take it out early, you get a penalty. And then finally, money market mutual funds are also included in this. You don't really have to worry about what those things are. It's just a slightly less liquid, but higher return savings account for all intents and purposes. Now let's look. So this is a little bit outdated. Checkable deposits is a little bit higher. Currency is a little bit lower now. These are, once again, figures from January 2010. So then this guy here is a little bit different too, but for the most part, this is what it looks like. M1 is about 1.6 trillion. It's a 1.8 or 1.9 trillion now, I think. But then when we get to M2, we're looking at 8.5 trillion. Okay, so that's obviously a lot more money. M1 is here, and M2 is this whole circle. Okay. So M2 is obviously much bigger. So why is the money supply backed, or what is the money supply backed by? What does that mean? Well, it is guaranteed by the government's ability to keep value, okay? So it is stable, okay? That's why people like money that is issued by a government, and they're a little bit leery of money that's not issued by a government. So obviously everybody's talking about Bitcoin, but in the grand scheme of things, people do not trust Bitcoin. Bitcoin is a speculative investment because it's not easy to actually buy things with Bitcoin. So that's part of the reason that Bitcoin isn't all that useful. It doesn't have a lot of acceptability, okay? And many places do not recognize Bitcoin yet as legal tender. Now, if you look around, some places do take it, but a lot do not. So additionally, prices affect purchasing power. So we're primarily interested in purchasing power of money. That's what really matters. We want to avoid hyperinflation. We've talked about that. So what can we do to stabilize money's purchasing power? And ultimately, we use good monetary and good fiscal policy. So we've studied fiscal policy quite a bit. We're going to be studying monetary policy now. That's what we're going to do, okay? So our central bank, which is the agency that sort of backs the money along with the Treasury, is primarily the Federal Reserve, okay? So Federal Reserve was started because we've had some banking scares and some crazy stuff was happening back when there were regional banks. You guys might remember from U.S. history that, you know, the original colonies each had their own currency. You can imagine how crossing state lines and requiring different currency could be difficult and not so good. So we started the Federal Reserve, I think, in 1913, and it is comprised of the Board of Governors, and then there are 12 banks, okay? So this is the central bank. It is not really a public bank, meaning you and I can't just go there, but the bankers go there, okay? So all the commercial banks do their banking through the Federal Reserve. So this is what it looks like. There's the Board of Governors, and they sort of control-ish the 12 Federal Reserve banks. There's the Open Market Committee off to the side. That is comprised of some members of the Board of Governors and some of the presidents of the Federal Reserve banks. These guys do monetary policy. Okay, so monetary policy is largely conducted by the FOMC, the Federal Open Market Committee. Now, the Federal Reserve banks supervise the commercial banks and then what we call the thrift institutions. The thrift institutions' popularity has gone way down and commercial banks' popularity has gone way up. And then you and I are down here. So that's kind of how the Federal Reserve works. They do monetary policy over here, and then they help control banks so that you and I, the public, get what we expect. So here's a map of where they all are. Notice it's kind of cool. Missouri is the only state with 2 Federal Reserve banks. You'll notice, obviously, that all but one of the Federal Reserve banks are on the east side of the country. And that's because when the banking system began in the early 1900s, this is where all the people were. This was just open air. Nothing was really happening out here except for a little bit around the gold rush here in California. But since the people were here, this is where the banks were, and that kind of tells us why the banks are located where they are. So, the Open Market Committee is very important. They set monetary policy by conducting open market operations, and we'll go into that in a great deal of detail in the future. Okay, these numbers are changing as well. Like I said, these becoming more popular, that's becoming less popular. So what does the Federal Reserve do? It issues currency. It issues it. It doesn't print it. The Treasury does the printing. It sets the reserve requirement, which is how much money, what percentage of the total amount of money in a bank that the bank needs to keep on hand. It lends money to banks when banks need money. It clears checks. It acts as a fiscal agent for the U.S. government, meaning some of that fiscal policy gets cycled through the Federal Reserve, supervises banks, and it controls the money supply. It controls the money supply, and that is, pretty important. Don't worry about this line. That was an error. Here we go. So, it was established by Congress. It is not a part of the government. It is an independent agency, and that is designed to keep it out of pressure from politics. Sometimes that works really well. Sometimes it works a little bit less well. But basically, you can imagine if the best thing for the government, if the best thing for the economy is to increase interest rates, and politicians have control, every time elections roll around, they're going to want to lower interest rates because, the economy tends to heat up. But of course, sometimes the economy shouldn't heat up. Sometimes that's not healthy. Sometimes that leads to bubbles. So if the Fed were responsible for listening to politicians, then they might make less good decisions. Okay? So that's why it is an independent agency. That's the theory behind it. So you can see the largest financial institutions. That's kind of interesting. Pause if you'd like. Notice we've talked a lot about the mortgage default crisis, but there's a lot of different causes. During the 80s, we made a big priority to purchase homes. Then real estate values went down. And then we have the whole mortgage-backed securities situation that you know about from watching The Big Short. The idea of securitization, so this is where you take so imagine a layer cake. So you've got layers and layers and layers of different things. So this is, the bottom layer is bond A, the middle layer is bond B, and then bond C. Securitization takes all of these things and then it slices it up vertically. So you get little pieces of these different securities. And the idea is that it minimizes risk. But the system kind of collapses as people defaulted on their loans. And basically, they became what were called toxic assets because, when you get your one little slice here, maybe only this bottom layer is bad, and these layers are good. The problem was it got sliced and diced so many times that you didn't know if it was bad or good. You just knew that you had a security with a little bit of bad and a little bit of good, but you didn't know how much of each. So nobody would buy anything on the chance that you had more bad than good. Watch The Big Short if you haven't. They go through it really, really well. We can kind of skip the rest. This is getting a little bit more specific. I've talked about TARP, the Troubled Assets Relief Fund. So this was when the government purchased a bunch of those troubled assets in order to save institutions from failure. We don't have to worry so much about this any longer, nor do we have to worry about that. And we're going to skip this for the time being. Oops, sorry about that. So you can kind of pause and read through this. Those of you who consider yourselves interested in banking or investing will want to understand this, but it's not terribly important for our purposes today. And I think, once again, we're just going to skip through a lot of this stuff and talk about it a little bit during class. But we will definitely focus on credit and debit card transfers, and the difference between credit and debit. So debit cards are essentially checks. They're just convenient checks. Okay, so think of that as a check. A credit card, though, is not. A credit card, it's not money. What it is a really convenient way to take out a short-term loan. Okay, so when you buy something with a credit card, the credit card company fronts some money to the place that you're purchasing from, and then it gives you a short-term loan, right? So then you pay it off at the end of the month. And they get a transaction fee for doing that, and then potentially they get interest from you if you don't pay it all off on time. And that's going to be where